Thank you all so much for coming to the session. It's really delightful to see so many of you here. The session that we're going to talk about is this whole question of, when we think about poverty typically and people who are poor, it does conjure up people who have less money. Really, this session is about, is that all poverty is about? Or how does that affect the way people operate psychologically? What does that do to your mind and what you allocate attention to and so on? And therefore, how does it affect the kind of decisions that poor people make? And we have three very interesting, distinguished panelists who can speak to that problem from the work that they do. So I have to my left Alissa Fishbane from Ideas 42, which is a think tank on what I call behavioral economics. She will tell you more. I have James Kirkup from the Social Market Foundation in London, and Faisel Rahman, who is from Fair Finance. And I'm going to just start us off in the session today by giving you a bit of a brief background in terms of the research I've been doing in this space. I'm better at sort of shining a light on the problems, and they are much better at coming up with solutions. So I will go first for that reason. And so just by way of motivating something that never seems to go away in the UK is the Brexit vote. And the Google searches on what is Brexit peaked on the 24th of June, which was the day after the vote. You'd think that we would all have paid more attention before. But among the many reasons, and we are still analyzing them as to why the vote happened, one of the reasons that's been given is the financial austerity and uncertainty that a lot of voters face. And in my research, I sort of studied this link between financial uncertainty and the attention allocation. That's what I work on. And while the jury is out on the wisdom of the Brexit vote, and it may be a while before we know, the fact is that poor people and poverty has been correlated with a lot of bad choices. So poor people are known to have, for instance, they're not as attentive parents. They have fewer conversations with their kids, because of which by the time kids are 4, they have a smaller vocabulary, and so on. And they are less good about keeping up with, for example, washing hands and this kind of thing. And they're bad at financial planning. And so because many of these decisions are not about being poor per se, people start to think that this is not about lack of money, it's about something else, and it's bad choices that are in fact keeping people poor. But in my research, and that I've done with a bunch of co-authors, we've been trying to think about whether this could be the other way around. Could there be something about being poor that pushes people towards these bad choices? And the question that we've been asking is there something about being poor that is these dumb choices that are getting people to these outcomes, or is there something about being poor that actually, makes you dumber, somehow distorts what you focus on or pay attention to? So we've done this in a bunch of ways, and research we've done in different settings. So one study that we did in the US was in a mall in New Jersey, where we presented shoppers with 2 types of hypothetical car problems. So one was just a $300 car thing which needed a fix, and the other was a much harder problem. It costed $1,500. And while they were thinking about how they would cope with this problem, we presented them with a bunch of IQ tests, so of this kind. And what we found is that when it was the easy problem, when it was just $300, as rich and poor people did equally well. But when it was the $1,500 harder problem, the performance of people who were poorer dropped by about 13 IQ points, right? And that's like going from somebody whose intelligence is at age 45 to 60, right? So it's a big dramatic drop. We did a similar study. This is with sugarcane farmers in South India, where we measured the IQ performance of the same person before versus after harvest. And sugarcane is a very long crop cycle, and right before harvest, the farmer is really down to the wire in terms of the budget. And a few weeks after harvest, they get all their money. And so when we did that study, what we found is that, like with the people in the car problem in New Jersey, these sugarcane farmers and things that are happening in their real life, their IQ performance dropped by about 10 points, right? So it's quite substantial. And being poor, again, is not just about having low incomes, it's also about uncertain incomes. And I think that adds a whole new dimension to the vulnerability of the poor and how that sort of occupies their mental bandwidth. And so we did this study with farmers who are very drought prone in Brazil, where throughout the rainy season, we sort of tracked them and we primed some farmers to worry about how they would cope with the drought. And then other farmers were just asked about soap operas because everybody in Brazil, loves soap operas. And similarly to the other studies, we found that people's IQ drops by, a substantial amount. It's as if they go from being primed to worry about the drought, reduces their performance from that of a 5-year-old, from a high school person to that of a 5-year-old. So it's a substantial drop. The one other interesting dimension that we found in this study was that they did worse on all IQ tests, except things which were water-related words. On those, they did much better, right? And those, because water was sort of on top of their mind when we primed them to worry about the drought. And so the takeaway from all of this is that when we think about the poor, we think about them in terms of lack of material resources, but it literally captures your brain if you have to always be worrying about how you're going to pay that next bill and juggle very uncertain incomes against your expenses. And so, I realize, and when I introspect about this as a parent, that when I have short on time, I make the similar kinds of mistakes. I'm not as attentive with my kid. The only difference is I can pay for a nanny, right? So my money sort of makes up a little bit for my lack of time, which a poor person doesn't have the luxury of. And there have been a bunch of other studies, some of which I've been involved with in terms of cash transfers in Kenya, where people do much better in terms of decisions about when they want the money, if they have if they've just paid off their bills. So they behave very differently. There's a study from the US which shows that people who are poorer, when they have these kind of bandwidth challenges, they disengage from politics if it requires anything other than a 2-minute attention. And there's also a new study from Brazil which looks at parents and them getting text messages for their, about their children's performance in school. And when people are primed to worry about their bills, they're less likely to sign up for these text messages, even though they have experienced the product and they know that it's actually good for improving their children's performance. So like I said, I'm good at setting up all the problems and pointing out that poverty is this double whammy, not just low income, but also low mental resources. I'm going to now leave it to all our other speakers to tell us about how to deal with these challenges. I'll stop there. So over to you, James.
Oh, right. First, hello. Thank you very much, Anandi. So I'm the director of the Social Market Foundation. We're a think tank based at Westminster in London. So I apologise for being terribly parochial. We're very British in our focus. We work with a lot of government departments and British regulators. As the name suggests, our interest is in the way markets operate and hopefully trying to suggest ways they can be made to operate a little bit better. I should apologise first of all for that. I don't do slides, I'm afraid. I just talk, so you can gaze wherever you want when I'm talking. I will try and do 5 things in the 9.5 minutes I've got left. I'm going to talk about poverty premiums, loyalty penalties, technology. Talk a little bit about why this matters, and then go on to the last difficult bit about what we should do about it. The first one, poverty premiums. Now, I point out, we talk about markets a lot. I'm not an economist, but we do talk to economists a lot. And not long ago, I was talking to quite a distinguished economist who came to our office to talk about something else. And we were talking about poverty premiums, which is, essentially the poverty premium is, if you are poor, you're more likely to be paying more for the same goods as someone higher up the income scale. And my economist friend said, that doesn't make any sense. Price discrimination means actually it should go the other way, surely. Because suppliers should price according to the propensity to consume of customers. So why would this be happening? Of course, the simple answer is because companies aren't run by economists and consumers aren't economists either. There are lots of reasons for poverty premiums existing, and lots of different factors involved. To give you some idea of the scale of this, I mean, lots of debate among academic and non-academic researchers about quite how big a problem this is. There's a very influential study by the University of Bristol which suggests that low-income consumers in the UK, when you look at what they're spending on utilities, telecoms, groceries, they're paying £490 a year more for the same basket of goods as someone at the midpoint of the income scale. We did the same. We have a slightly different methodology of looking at this. We think the number's more like 256 to be precise. We could go through the methodological differences all morning, but I won't. The important distinction to make in poverty premiums is between the bits of the premium that are imposed on people, on consumers by suppliers, and the bits of it that come from their own behaviour. So the imposed components tend to be smaller. There are things like in energy. If you don't pay for your energy with a direct debit, and your supplier says you're going to pay with a prepayment meter, you're going to pay more for that. If you literally don't have any choice, that is something your supplier imposes on you, and you have to then pay back the cost of the box, the meter, and also the risk premium, the credit premium that your supplier is going to pay. So that cost is being imposed on you. The bigger component of the poverty premium, though, is effectively your own behaviour. Because what we know is that people who are in this category, subject to the poverty premium, they don't switch as much. They don't shop around. And this brings us to point 2, the loyalty penalty. Now, to think about this stuff more easily in our work internally, and when we try and communicate it to politicians and people who don't live and breathe this stuff all the time, we tend to talk about, we try and make it a story of archetypes. We talk about 2 people. We talk about Martin and Mrs. Miggins. Now, these are quite British references, sorry. Martin stands for Martin Lewis from Money Saving Expert. If you've come across this is sort of...
A website.
It's a website that for people who obsessively track the price they're paying for their utility bills, their overdrafts, where they swap tips on how to minimise your spending on absolutely everything. Now, so Martin is the savvy switching consumer. Martin is doing essentially what the classical economic textbook says he should. He's maximising utility. Mrs. Miggins, the name just comes from the fact that I was a big fan of Blackadder in the 1980s. Mrs. Miggins doesn't do any of these things. Mrs. Miggins stays loyal. Mrs. Miggins stays with the same consumer year in, year out. And as a result, Mrs. Miggins pays more. Now, lots of reasons why Mrs. Miggins doesn't do that. Some of it is capacity, because Mrs. Miggins might not have the internet, might not be comfortable using the internet. She might not be able to tap into moneysavingexpert.com and all the other tools you can use. Mrs. Miggins might be risk averse. She might be wary about trying to switch suppliers and having a bill overlap where you've got to pay 2 people at the same time, particularly if you're on low income. That's something you can't afford. She might also literally, and we do know this from some of the work we've done, she might be concerned that if she gets it wrong when she's switching the gas supplier, they might cut her off. Now, that won't happen, can't happen. There will be continued supply, but there's still a perception there. So there are lots of reasons why Mrs. Miggins doesn't switch around. Now, I should point out that we are obviously talking about poverty. Just to make this more complicated, not all Mrs. Migginses are poor, and not all Martins are rich. Actually, this is something that Anandi, I think, alluded to. Particularly among low-income consumers, there are some who are very, very savvy and very active and very engaged. And there's some evidence to suggest actually someone on a low income is more likely to have a really good grip of particularly the smaller items, because obviously, naturally enough, they're paying attention to how much you're paying for vegetables or groceries, whereas bluntly, probably quite a lot of us in this room wouldn't know to the penny how much we pay for a pint of milk. Absolutely. But people lower down the income spectrum do. So not all Martins are rich. Not all Mrs. Miggins are poor. In a real sense, to channel somebody else, we are all Mrs. Miggins sometimes. I was Mrs. Miggins earlier, not too long ago, when the letters started coming through my letterbox telling me that my insurance, my home insurance, was up for renewal, and I knew that, because I do this for a living, I knew that I should really engage with it and look at it and go and shop around. But another envelope, and there was something slightly more important to do. And before I knew it, the auto renewal had gone through, and I was paying £75 more a year to insure exactly the same house in exactly the same area. And that, so I didn't have the bandwidth for whatever reason. Is that back to my my classical economist friend, who, when we talked about this, said, "Is this really this? Is this actually a problem? Isn't that revealed preference? Isn't that when we have people paying more for something, when we have someone choosing not to shop around, aren't they essentially expressing the view that they value the time that they would spend shopping around more highly than they value the benefits they might receive from shopping around?" Now, in my case, that was pretty true. I mean, I probably somewhere, I'd probably decided actually, the time I could have spent shopping around my insurance, I would rather spend it sitting on the sofa watching Netflix or writing columns for newspapers or whatever it is I do in my spare time. But if you look at Mrs. Miggins, the low-income Mrs. Miggins, if she's in the bottom income decile in the UK, she's got a household income of £160 a week. By not switching energy suppliers, she's costing herself £300 a year. And that's not really rational. Now I'm running out of time, so we will get on to technology. Now, technology may answer some of this stuff. Technology may make it easier for Mrs. Miggins to switch around. There are lots of the next evolution of money saving expert is something called Flipper. Flipper will allow you to go along, plug your details in, and when your utility policy is up for renewal, Flipper will automatically switch you, so you will get a better deal. The problem is going to be, and I'm sure Faisel will talk more about this, Flipper is going to be used by the Martins. Mrs. Miggins is not going to use Flipper, and a lot of the people who are making Flipper are not selling Flipper to Mrs. Miggins. So where we may end up is a situation where technology which could equalise the outcomes within markets actually widens that spread between Martin and Mrs. Miggins. Now, why do we care? And again, an economist would say maybe this is just price discovery. These are efficient markets clearing. We're discovering the real value people place on goods. This is efficient. This is fine. I work for an organisation called the Social Market Foundation. We think that markets aren't just economic artifacts. They have a social dimension. When you get it is possible for a market to be efficient and also unfair. And if something is seen to be unfair, it is not politically sustainable. And the sort of spread in outcomes I've been describing are what allow politicians, and I shan't name them, but you know who they are, to say the system is not working, the system is rigged, things are unfair, you are being cheated. And that leads to anger, and that leads to outcomes that we probably don't necessarily like. What can we do about this? This is quite deliberate. I've taken up all my time in the analysis to avoid the prescription, because the prescription is really difficult. I can tell you two things that probably don't work very well. Price fixing doesn't work really well because the instant you tell people that you're going to fix their prices, they disengage. They think they don't need to engage and switch around. I also think that information is probably limited in what it can do. I think that, given the cognitive bandwidth issues that Anandi's identified, the idea that if we just make markets more transparent and clearer, we will not, they will begin behaving like rational economic agents. That doesn't work. The answer, I think, partly is to do with technology and product design, and hopefully, Faisel will talk about this, trying to encourage more challenge, more of that financial innovation, financial and technological innovation to provide products for lower income consumers. And the final point I'll leave you with is regulators. I think there is a conversation to be had across the developed world about the role of regulators in markets. It is starting to get away a little bit in the UK. The Competition and Markets Authority and the Financial Conduct Authority are starting to investigate some of the issues I've talked about this morning, but we're on the very early days. But there has to be a new and much more assertive role for regulators. I'm sorry, I promised to go into time, but I went over by a minute.
That's all right. Totally fine. Thank you so much. I think it's really interesting sort of thinking in terms of, it's not that people who are poor are systematically worse about focusing on their money in every way, but small things they do pay a lot of attention to, but maybe almost too much attention to being penny wise. But then when your attention is captured by how much you pay for vegetables or whether you have water on the top of your mind, then things which are more global and just not as urgent, whether it's about your $300 insurance or whether it's about being a better parent, you just have less bandwidth left over for. I'm going to now hand it over to Faisel, who's been working with designing better financial products for the poor people and sort of has a lot of experience trying to think about from inside their head, and how are they encountering these problems, and in what ways are the financial products which are currently offered falling short, and how can we design them better to aid them to make better choices. So over to Faisel.
Take the flicker, or whatever it's called. Flipper, flapper, button. I'm going to stand. Is that okay? I've got slides, so I'm going to stand if it's a bit easier. So thank you for inviting me.
Oh, my pleasure.
I've been involved in, I guess, what some people call, if they're polite, financial inclusion. If they're less polite, they're called subprime lending. For the better part of the last 20 years, I've worked in microfinance abroad, and for the last 15, 16 years, I've been running and developing microfinance services in the United Kingdom. I did that because actually there was quite a lot of similarity between what I discovered to be the choices that people made who were excluded in villages in Bangladesh and the choices that people were making in the United Kingdom, which might sound weird to many, but actually for me was very, very normal. My parents are from Bangladesh, so I grew up having to listen to terrible musicals and listening to my dad recite poetry in Bengali. But actually one thing that they did do is, when they arrived in the UK, my dad didn't have a bank account until 1985, 1984. They came in 71. And they used quite a lot of informal lending, so I was quite aware of what was happening in the UK if you didn't have a credit history, you didn't have a permanent job. And so when I came back after working in Bangladesh, I knew that this was an issue here. And at the time, not many people were talking about it, so I'm just going to use a couple of slides to give you some numbers and stats about the United Kingdom, which are probably a bit more well-known now, but they weren't so well-known before. Sorry, that's just my office. That's one of 6. So this is how people think about the market, I suppose. This is the people who borrow money in the United Kingdom. They're broken down between prime and subprime groups, people who are using mainstream banks, people who are in the near prime, they're moving in and out of the kind of the subprime, and below the subprime, you'd have the really excluded people who use a cash economy and maybe use money lenders. Just to give you an idea of the type of lending, this entire market down here, this is 10 to 12 million people. This represents £72 billion in the United Kingdom, so it's a pretty big market. A lot of that is very high-cost mortgages, which people use. About 5 million people use a pawnbroker or a catalogue. They buy their clothes, school uniforms from a Littlewoods type catalogue or an Argos type service. Quite a lot. We probably know a lot more about people like payday lenders who are serving a couple of million people, who charge around 1,500% for small loans of £200 or £300. And one thing that I've discovered is quite unique to the UK, it seems, at least in Europe, is home collected credit. There are nearly 2 million people who borrow from a person who comes around to your house and lends you money in the UK right now. And they'll charge you up to 700% for the privilege. And they usually lend around £400 or £500. They're totally regulated. All of these are all regulated institutions. Yeah, they lend money to people. Just to give you an idea of who are the users, this is some data from the Financial Conduct Authority, which regulates that market. Just to give you an idea of what the demographics and the economics of some of these people are, some of the data that's put up there. But broadly, if you wanted to classify them, they are people who are self-employed. They have what we would call credit impaired, i.e. they've made a bad decision, they have a bad credit history. They usually are low paid, they generally have part-time employment. There's a significant portion of these people are recent migrants. They have, in some cases, no credit history. This could even be people who lived in England all their lives, and they might have no credit history because all they've ever done is save before they've spent. And so they look like a terrible borrower, which is probably what they are. They're a good borrower. And typically they just have no assets. That's the group of people who this 10 to 12 million people in the United Kingdom represents, which is a pretty significant number of people. And clearly, there's a lot of structural issues that force people to use some of these lenders around. I mean, obviously, things like credit history and data make it difficult and problematic. Assets and information around those assets also make it quite hard for people to make decisions around it. But I want to go a bit deeper into some of the products that these people are using and just tell you a bit around how they work. There's something quite interesting about the design of these services, and I was really fascinated, having spent a long time both with money lenders in Bangladesh and in the UK, but also payday lenders and doorstep lenders, is that if you try to break down some of these products, you discover some interesting things about how they're designed. So firstly, they're unbelievably flexible. You can pay per day. You can pay per week. You can pay on the 26th, the 27th, the 23rd, the 15th. You can pay every 2 weeks. Previously, people who were on benefits used to receive their benefits every 2 weeks. It's quite handy to have a collection that comes out every 2 weeks as opposed to every month. And you can change it just like that. You just tell the person you can shift the timescales. All of these products enjoy that level of flexibility. They're very clean and transparent. Now that might sound weird when you see companies charging 15 or 1600%. That sounds pretty dodgy. But the reality is that a payday loan isn't 1500% to most people who use it. It's £30, 100 every month. It's really easy maths. It doesn't change. A doorstep loan isn't 733%. It's £20 every week on a £500 loans for 50 weeks. It's really simple maths. And it's really transparent because there are very few penalty charges on this. Most people who use these services have come from some experience where they've used a bank account which has charged them for an overdraft. Moving 1 penny into an overdraft will charge you £30. Bouncing a direct debit might charge you another £30. Moving into an unauthorised overdraft will charge you another £30. You might find yourself £100 into overdraft without having done anything other than have a day late in the pay that you're receiving from your employer. And being charged like that it seems pretty untransparent, actually, especially when everyone talks about free banking. So these services are unbelievably transparent, really clean, and very simple. And they're quick. They're really, really quick. I mean, it used to take up to 5 days. I think it still does take up to 5 days to get a credit card. Do you know how long it takes to get a loan from a payday firm? Like less than 5 seconds, actually. It's pretty fast. And a doorstep lender just does it on the spot, instantaneous. Speed is a really powerful driver of people wanting to choose this. And ultimately, they know who many of these borrowers are. And I'll talk to you a bit about this in a bit more detail, but often you realize that less so the online payday lenders, but many of the others, like the doorstep lender isn't a man with a baseball bat and a Rottweiler coming to your housing estate. It's usually a woman who's lived on your estate. I lived next door to one for many years, Tracy, whose daughter and granddaughter lived on the same estate. Weirdly, my mum visited me once, and Tracy still remembers my mum's birthday, which must have been in a 20-second conversation they had outside my house. But everybody knows her. She builds relationships with people, and you trust her. And what you've got here is quite an interesting mix of product design principles. You've got a very personalized, highly bespoke, relationship-based financial product. It's something that we currently see in the market in the United Kingdom, but it's only for the very rich. And so I would argue that many people who use these services do so out of choice, and they are happy to pay some of this cost. Maybe not always, but they are happy to pay some of this cost for the certainty, transparency, and speed in which they receive some of these activities. Now, there's a broader question about fairness and ease in which you can move between different markets. But I think to misunderstand that there is a choice element going on here completely misunderstands why some people use these services. I'll just give you a very quick example of a person we made a loan to. Not George, Jorge actually is his name. He has a bank account. He has a bank account with Barclays. He hates Barclays. Barclays charged him for an overdraft. Barclays were really annoying. They didn't like the fact that he spoke with a Spanish accent. He absolutely hates them. But they're a bank, so he gets his pay paid into his Barclays account. But he gets it transferred instantaneously to a prepaid debit card called Pocket. He likes Pocket. Pocket are really transparent. They charge him for every transaction he makes, but they tell him how much they're going to charge him for it. They never let him get into overdraft, so he never has any unnecessary fines and charges. And they have a really nice cover, a really nice skin that he can use on his mobile phone that allows him to understand how he's spending his money. Really nice. He uses Azimo, which is an online mobile remittance firm, because he has a cost. He sends a fixed amount of money to his family living in Peru every month. He needs to make sure that that's a consistent amount of money, and he needs to know it's super cheap. Azimo is much cheaper than Western Union and his bank. He gets random bills every now and then. Water bills, they come every 6 months, so they're a big chunk. He uses Oakham. Oakham is a money lender in the UK, which will charge you 14 or 1,500% for the pleasure. But everybody who works there probably speaks Spanish, speaks Polish, speaks a language that he understands. So he knows the person in there. He was introduced to them when he first came into the country. He trusts them to make a quick and fast decision. And occasionally he goes to the pawnbrokers because he has some gold and he might have a cost or an individual item that he might want to pay. Interestingly for him, and this is something I hadn't appreciated, he also uses a Christmas hamper scheme because he wants to make sure that he has presents for his family. Have you come across this? This is where you put £10 or £20 a month or a week away, and then at the end of the year you might have saved £500 or £600 and you get a hamper of £200 or £300 of value. But what it does is it forces you to save and you end up with a present that you can give out to your friends and family. It's used by about maybe 1 million people in the United Kingdom. He uses it. I was surprised. Jorge's been in the country for 16 years now. So I think understanding this has a couple of interesting ramifications. I suppose one thing is just trying to understand this problem. So if you think about from a policy perspective, people think about what you would call financial inclusion as being banks and credit unions and what they offer and how they offer it to be what the focus of all policy should be about. And anything else is exclusion. It's dodgy, it's difficult. But the reality is something a bit more different, I think. And I think people like Jorge and many, many others who use these services all the time have a much more sophisticated relationship with financial products and services. They're active agents in change, and they exercise that change. Now, some of those change might just be very expensive, and they might be bad to some of us or difficult to use. But the reality is that all of these feed some useful requirement that that person needs, and that person's actively choosing to take some of those to make decisions around. So unfortunately, this is not a picture of Jorge. Jorge didn't allow me to take a picture of him, but I wanted you to understand a little bit more around what was going on around Jorge. So he does have difficulty accessing mainstream credit, partly because he doesn't have a credit history. He's been here 16 years. He hardly uses the bank. The only time he's used the bank was when he has an overdraft charge. So he doesn't really have access to mainstream finance. So he does have only expensive choices. But the interesting thing for him is he has residency and legal challenges. He doesn't know whether he can stay in the UK forever, so he has to spend quite a bit of money on legal fees, talking to lawyers. He has legal challenges, partly linked to his multiple jobs. He has 3 jobs. He works 57 hours a week in his 3 different jobs. And half the time, he's still chasing previous employers for pay. So he's got some issues here that he needs to resolve. And he's challenged by welfare reform. Universal credit is changing. He doesn't know if he can receive housing benefit. And of course, living costs and tenancy are difficult for him because he's privately rented. What's interesting for him is that all of these things require something that he can trust to fix, someone who can help him in that process, and someone who can engage quickly. And although he works that long, he doesn't have lots of savings, and so the decisions he makes are very fast, are very quick, and he needs someone that can work around it. And currently, today, the only service that he can use that helps him deal with all of those risks in his life is money, is finance and credit. It's going to Oakham, it's using the payday lender because he knows and trusts them to give him the money to fix those problems and to resolve them. And I would argue that one of the challenges about fixing this problem is realizing that most of the problems that Jorge is experiencing and many others on low income are experiencing are less about money than they are about all of these other vulnerabilities in their life. And for as long as it stays easy and simple and quick to get high-cost credit, we will keep using high-cost credit to fix problems that could be much better fixed in other ways. Thank you.
Thank you so much. So, that was very insightful because we learned that, yes, part of the problem in terms of the decisions poor people make are about a lack of attention. And like James said, it's not all about revealed preference. Some of it is inattention, but there is capture. But what we've learned from listening to Faisel is that some of these is also because the structure of the products which are made available to poor people are not responding, are not listening to the needs that they have. They are sort of very rigid in a bunch of dimensions that he very eloquently pointed out. I'm going to now turn to Alissa. Thank you, Faisel. That was really very interesting. Alissa is now going to talk to us about, she works at Ideas 42, the most commonly used way of reaching out to poor people in developing countries, which is cash transfer programs. And this is a study she has done in Madagascar, and she's going to talk to us about how they introduced elements into the design to improve the use of the money that people had from these cash transfer programs. So over to you, Alissa.
Perfect, thank you. And do you mind passing it on? I think I'll have a presentation coming up. Good afternoon, everyone. Anandi, really talked about this psychology of scarcity, and we've heard a little bit more about it from all the other speakers. And Ideas 42, we were founded in 2008 at Harvard University with the idea of taking all that we know around human decision-making and behavior and bringing it to bear in the social sector. And so that's what we do. We've since spun out as a nonprofit working in 35 countries, but what we're doing every day is looking across the board at all different sectors and saying, how can we either create new programs and policies and products or work with existing ones to improve them and increase outcomes for people. I have some slides if they're
I think they're on.
available. Oh,
yeah.
Perfect. Except it might be there. Oh, I don't think they're working. We'll see. We'll see how this goes. Either way, we'll do great. So I'm going to talk to you today a little bit about this program we're doing in Madagascar, which is one of the countries we're working in. And then I'll end with some strategies in terms of how to think about designing in general for the context of scarcity. So cash transfer programs, there's been, if you don't follow them, there's been some really great evidence recently about how they support human development across a number of sectors, from health to education. And with this, there's been a really nice push in innovation. But so far, most of that push has been on the cash side of the transfer system. So how do we improve targeting and getting to the right people? How do we minimize leakage and increase efficiency? But we really have this untapped well of the people, the other side of the transaction. How are they making decisions and empowered to best use that money? And how do we support what we know are these kind of mental burdens of poverty? And so we're doing a number of work around cash transfer programs right now. And the first one where we started is in Madagascar. Now, Madagascar has the highest stunting rate among children in the world.
Wow.
And so this program, we're working with the government as well as the World Bank, who's supporting this program. And these payments are to families. They're unconditional, but they have to be to families with young children. And there's really, two aims of this program. The first is to provide a safety net. These households are very vulnerable. This is about a third of their income. But the other pillar is to foment human development, increase human capital for future generations, to be able to unlock that economic potential. So one of the things when we start to look at any problem is, for this to work well, we understand what the program's intentions are in terms of human development, but what about the people who are receiving the funds? And what we see when we dig into the problem is really the mothers who are collecting these funds every other month, they understand this pathway. They really have a strong ambition for their children to live outside of poverty. They know that they have to grow up healthy and attend school to do so. They know that to be healthy, they need to eat well. So we see that so many of the pieces along the chain are working out quite well. They have all the information and knowledge they need. But where they're really struggling is taking the limited resources that they have and investing in them in a way that is furthering their goals. And so this is specifically what we're focusing on. Anandi talked about interactions with parents and how that can be really challenging when you are very scarce on both money and time in a household. When we did the baseline survey, we found that in Madagascar, these parents were spending about 2.5 times a week in meaningful interactions with their kids. Now, they were interacting much more day to day, but actually sitting down, playing, reading, things like that. So once we were clear on the problem, the next step is to really understand, well, what's inhibiting that behavior? So these women have a very strong intention, but the actual goal is not being realized. And how do we help them do that? And we found really two pathways. The first was a more psychological pathway, and the women, as you can imagine, have been living in poverty their entire lives. Everyone around them that they see is living in poverty, and so they don't feel like they have the agency, despite as many efforts as they've put in so far, to be able to escape that. And so this is a really powerful identity that can hold them back. And in addition, not only is that it's reinforced by things like you are eligible for this program, you need extra help. The second pathway, or as we think of them as a behavioral barrier to realizing your goals, is what we think of it happens in the spending journey for these funds. So these women, to collect the funds, every other month they go to an area near the marketplace. And so when you get the funds, it can be extremely tempting to spend money in the marketplace, especially if you don't have a clear goal of how you're using that money. And you see everyone else around you spending money in that marketplace. And the second challenge, which I already alluded to a little bit, is there's no clear moment to plan. And so these women sit around for a few hours waiting for the funds to arrive. And they're thinking very much about their daily needs and what needs to happen. But they're not being prompted to think about their longer-term goals and how those fit in together. And so what we did was we created 2 different interventions aimed at helping these women set realistic goals and follow through in executing them. And the first intervention arm is what we call self-affirmation. And so this is really addressing the psychological barriers that we found. And so the exercises were about affirming their values and identities in order to not only clarify their objectives, but strengthen their power to then follow through and act on them. The second, the plan making, is a little bit more of a practical approach. So it's being clear on your objectives and your goals, but then saying, well, what is standing in the way of my goals day to day? And what actions can I be taking to overcome those? And so we worked a lot on really getting the design right. It's a group of women with varying levels of literacy. So the games are all, they're drawing, they're cars, they're stones, they're very visual. So each intervention has 3 activities, and women are either get one or the other. And over the next 3 times that they come to collect their payments, they engage in one of these activities. Now, originally we had some outside facilitators of the program staff helping to train everyone up to do these, but later these activities were taken over by a group leader called Mother Leaders. Now, these were also an addition to the cash transfer program that was being evaluated along with our arms. And they're really, just to give you a sense, these are women elected by their peers of the group to be the conduit between the program and the women themselves. And so any information about human development that needs to be passed along from the program or anything else, and vice versa, are going through these Mother Leaders. So these are just a few pictures so you can get a sense of what it looks like with the women doing these activities. So we just finished the midline after 18 months. This is hot off the press. I think this is the first time we've actually shared them publicly. And this is 18 months after we started the work. And what we're seeing early on is the planning exercise is giving a nice boost to parenting and the number of interactions that the parents are having with the kids each week. But then the affirmation exercise is giving a nice boost to things like social skill development and language skill development. Now, we actually think that these would be more related, and so what we're doing right now is doing some qualitative research to really unpack what's going on, and in the end line, hopefully we'll understand a little bit better the mechanisms here. But one of the things we're also seeing is that these behavioral interventions are increasing things like crop production and livestock investment, and so there could be some interesting spillover effects from all of that. Now, one of the things we always look for is how are these behavioral interventions supporting, and is it doing so in a cost-effective way? And so if you look at just the cash alone, because we're looking at this in a multi-arm treatment, we're able to isolate the effects of each one. And so just the cash alone, we get a nice boost in interactions each week with children. With the Mother Leaders program, we're getting another little boost. But with the behavioral interventions, we're getting about 2/3 the effect of the cash at 1/5 of the price. And so in this case, we really do think we're able to use these pretty cost-effective interventions to be able to really boost the human development aspect and aim of this program. And so we'll likely be looking at some sort of combination of approaches moving forward. Now, to end this, I wanted to walk you through some bigger design principles. That was one example of kind of a different way you can approach supporting the context of scarcity. But what we've done is we've really looked at how do you design for scarcity in the greater context, and what are some strategies that we can be using day to day when we're designing programs and policies and services. And so we really put these in 3 buckets. And I'll walk through very briefly, because I know we don't have a lot of time. I'll walk through very briefly what I mean by these, and then I'll give you a resource where you can find more information. So the first is cut the costs. So what do we mean by costs? We've already heard about the cognitive costs of living in poverty. The financial costs are pretty clear. There's also time costs, right? Just something as simple as having to take public transportation, 2 buses somewhere, you know, we add up time. There's a number of ways we can actually reduce these costs. And one of them we think about is reducing barriers to entry. So many services and programs, they love to ask for lots of documentation, lots of paperwork, info sessions, certain times you can be there. And every single one of these is a hurdle from people actually being able to access these programs and services. And so we're really thinking about how can you reduce those. One example of this very quickly is a financial aid form we use in the US. It's 60 pages long. All we really need to know is someone below or above the threshold? And it's not surprising to see that, we do a lot of work in this, but this is really one of the seminal early studies of it, that 40% of households are really only filling this application form out. When you give them information, it's not making a difference. So it's not that people can't do it. But there are a lot of things from just the hassle of doing it, the length of time to do it, the intimidation of the legal and jargon language that's being used. But what they did is, at an accounting firm that's supporting low and middle income families, is they help them fill out the form themselves. And we see with this that there's a really nice boost in people who not only fill in the form, but they also attend school, matriculate to school, and continue on attending. And so what I want you to take away from this is, not that we should be giving everyone assistance to do something, but if we have to give people assistance to actually get there, what can we be doing to cut down those barriers to make it easier to begin with? And then just very briefly, the next to create Slack. What I mean by this is, how do we build in that Slack? Most of us in this room are time scarce. We have a full calendar. If something comes up during the day, it can be pretty stressful, because how do we actually reorient our day to fit in that piece? The same thing when you're financially tight, you have an accident, you break your arm, all of a sudden a few $100s can be quite stressful, and then it's substituting for rent, utilities to get there. So how do we design programs that allow for these emergencies or mistakes that can happen? And then how do we support people with reminders? And then the last one, very quickly, is reframing and empowering. So I talked a little bit about how we were doing that in the cash transfer program. Lots of strategies here. One quick one is using intentional language. So instead of calling people poor or needy, customer, member. None of us wants a caseworker, but we all need a life coach. So I'm going to end there, but just say, for any of you who want to do more reading, the science behind it is all captured in a great book by our co-founders in the book Scarcity. Anandi's work and others are in there. And then if you want more practical ways to apply this research and design better programs and policies, we've written Poverty Interrupted, which takes the concepts it covers the concepts I talked about today, but really talks about all of them in more detail and more approaches. So thank you.
Thank you. That was really helpful, really insightful. So when we talk about challenges, it's not just in terms of attention, but it's also in terms of how intimidated people feel. And so the wording we use and making them believe that they can actually get from where they are to where they would like to be, it makes sort of focuses their attention and gives them more resolve in getting there. I'm going to throw the floor open for questions. I see somebody standing with a mic. The lady at the back, please.
Hi, I have a question specifically for Alissa. So,
for Alissa, yeah.
Yes. So, I actually happen to be working on that same World Bank project in Madagascar, but not on cash transfers, but on helping the government actually deliver chronic malnutrition interventions better in a more human-centered way. So I was a design coach there, so I'm very interested in what you said. So I was curious about specifically the nutrition results of what you were doing around the affirmations and the plans, because I know you had, it was child development, nutrition was also one of those things, right? So what were the results in that area?
I have to refer back on those. So
Alissa is the CEO, so she oversees all the projects. She's sort of not, on the ground with.
I have the answer in the full report. I just don't want to give you the wrong one because we focused on this to keep it really short. But yeah, we saw impacts across not all areas, but a number of different areas. And if you're interested, we'll be actually putting out more information detailing everything.
I'm sure she can share that with you later. We have a bunch of hands. A lady here.
My name is Blessing. I'm from Nigeria, and I'm a student here at the Blavatnik school. We have something similar in Nigeria, but then my questions are how, like, what's the, I don't know, the indicator? How do you decide who deserves to be in the program? And what are you doing for sustainability? So maybe you're going to do it for 2 years, 3 years. What happens to these people after that time?
She's talking about, are you referring to Madagascar program?
Yes, the Madagascar
Are
project.
you talking about the behavioral interventions themselves or the actual cash transfer program?
The cash transfer program.
That goes on, right?
Yes, so that will go on. This is a program that's funded by the World Bank. And really the idea is we're working not only in Madagascar, but a number of countries right now to see if we can boost outcomes through the use of combining these behavioral interventions with the cash transfer programs. And so the idea is to be looking for things that are fully scalable. So, cost effective, easy enough to do and administer, and that can be added on. And, they may vary slightly depending on the aims of each program. And we'll be testing a number of different things in different programs.
I guess it will be up to the government whether they continue having the psychological intervention component.
Yeah, so the final decision for this will be made after the 3 years of the study, but based on indications so far, it's looking positive.
We have a question here. Yeah.
I can appreciate the notion that mental load can actually affect quality of decision making,
Yes.
but I was just wondering whether the panel has found in your experience that society's gravitation towards instant gratification actually has a compounding effect on the poorer segment of the community?
So I don't know who, are you targeting the question towards anyone in particular? So, I guess, yes, your environment does influence what you tend to buy. We haven't sort of specifically worked on that question. I think that would be an added layer on top of everything else that we're talking about. But I think sort of based on what Alissa was talking about, based on the kind of challenges that Faisel described, the thing is that even when the intention is there, when there is capture with your urgent problems, it's very hard to think, stand back and think longer term. I think that's sort of what so what you're talking about adds another layer, because if there is we are all tend to want to have instant gratification, but it's just that being poor imposes a whole nother layer on top of that, because you're continually firefighting, and then that leaves you less space for thinking about things from a longer term perspective. But yes, what you're talking about adds another layer as well. Yes. Did you have a question, the lady at the back, Maria?
No, I was worried about the time, actually.
All right. Okay, I guess we are. Any other burning questions? Yes, there's one last question, and then I will. Yes, thank you.
Hello, Esther Dakin-Poole. I work within the disability sector.
Yes.
I was wondering if there were, within the facet of any of your research, elements of D&I that were built into that, so disability and inclusion, because that's a very marginalised sector that it's a compounded issue within poverty, and it's very often not genders put into many surveys, but poverty and disability in it is a very major factor in my understanding. I was just interested to know whether you'd included that.
Sorry, I should have just added, I run an organisation that serves 25,000 people a year around the southeast in areas around financial inclusion through products and services. Southeast England.
Southeast England.
And one of the interesting things, obviously, we see a lot of people who are on, I think they're now called PIPs, but used to be DLA, Disability Living Allowance, I think. I can't actually keep up to date with it.
Personal independence payments.
That's right. We see a disproportionate amount of people who are being kind of characterised as being high risk by the mainstream financial services sector because of items like that. So we see many more of them are using high cost credit than we would have assumed, or which I think just adds to the problem as opposed to saying it's a specific problem because they're disabled. But it does seem pretty clear that much of the financial structures are making some of those inherent decisions that if you're receiving PIP payments or DLA payments, you must be just generally a bit more risky. And you may find that you have these kind of quite large, lumpy costs, which are very difficult to pay for through your personal independence pay. So I would argue that it has an even a bigger compounding impact on people.
And in terms of developing country studies, I don't think that people even focus on it as a separate category. I will confess that it's not part of, a conscious part of the design and the studies that I have done in developing countries. I think the state is much further behind in terms of providing for people who are of that, with that challenge. So, unfortunately, at the moment, it's still silent on that question. Sorry. But, I think that we have got some interesting takeaways. Like she said, the psychological interventions give for 2/3 the impact of the cash intervention for 1/3 the costs. So, you can only make the cash transfer programs more effective to include them, not less effective in terms of getting people focused on longer term goals. Better design, and he has given us a lot of feedback in terms of what better design means, transparency, flexibility, simplicity. And I guess the question I'm going away with in my head, and I know because we're out of time, is why is it that we can't have more such products in the mainstream space which are catering to large segments of the population? I'll leave you with that. And